I would like to welcome you to the next in a series of PwC webinars covering the most important Polish tax issues. My name is Marcin Jaworski. I'm a senior manager in the corporate income tax department, and I'm joined today by Monika Laskowska, partner in our transfer pricing team, and Michał Małkiewicz, senior manager in PwC International Tax Services team. Today we have decided to discuss with you and share with you our views on several very important topics. The title of the webinar is mentions a revolution. It is a little bit of a throwback to last year's webinar regarding corporate income tax changes in Poland, which were, in our view at that time, very revolutionary. This year, in fact, the changes that are being introduced are even more broad, encompass, I think, a broader scope of issues. So that's why we also feel it's a revolutionary change. So we are in, at least in corporate income tax, we are in a state of a sort of permanent revolution, and we'll try to make some of the changes we feel are most important a little bit more familiar to you, especially to our English language speaking clients, English language speaking participants. What I need to mention is that we have selected only a number of topics, a bunch of topics which we feel could be most important, but in fact even more topics that are, or more items, more issues that are introduced into the corporate income tax law are not and will not be mentioned during today's presentation. So if you feel you would like to discuss, or you feel also other issues are very important from your perspective, please let us know about this in the comments. In the comments section, we have a chat with moderators. So also, if you have any questions that you feel need answering on the topics we are discussing, or on any others, please feel free to ask these questions. So without further ado, I will hand over to Monika to discuss the transfer pricing part, and later on we'll discuss innovations, international taxation, and particular corporate income tax issues as well.
Good morning, everybody. As Marcin said, among other things that we'd like to discuss today, we have also a proposition of new regulations that introduce sweeping changes to transfer pricing. With this respect, yes, I'd like to highlight a couple of issues that, yes, are the most important propositions from the government in the area of transfer pricing. I would say that the majority of changes involve the enhancement of efficiency of tax audit, and again increasing the transparency of taxpayers. The second sort of proposition of the regulation changes are with respect to the limitation of requirements. Mostly with respect to transfer pricing documentation. We have a proposition of new materiality thresholds. We have a proposition of a couple of new exemptions, which includes micro, small and medium enterprises. We also have the proposition for the exemption of transfer pricing documentation obligation for the local transactions. What is also interesting, the government proposed also the introduction of new provisions with respect to safe harbors. This implements the safe harbor solution for loan transactions, as well as low-value services. The key changes that I'd like to focus a little bit is, I would say, the new approach to the arm's length principle and broadening the scope of associated enterprises. The new scope includes companies that associate together with respect to individuals, with respect to the personal relations. And the second one is due to the relations set up without economic reason. So this obviously creates some sort of discrepancy with what is in the scope of double tax treaties and arbitration convention, and yes, this is the area of conscious with respect to the potential risk of double taxation issues that might be difficult to be eliminated. So taking this proposition step by step, let's look at the new materiality thresholds for local transactions that were proposed. So we have the proposition of introducing the 10 million zlotys thresholds for tangible and financial assets transactions, and 2 million zlotys for the other transactions. For master file, we have also a new proposition with respect to increasing the thresholds, which right now, which with respect to the new proposition will be 2 times higher. It is around, with respect to the Polish currency, 200 zlotys, which is around 47 million euros. What is interesting with respect to the new recommendation, new proposition from the government is that fortunately master file can be prepared in English language. So this is entirely new proposition, and translation into Polish will be expected only with respect to the explicit request from the tax auditor, from the tax authorities. For country-by-country reporting, we have still the same thresholds that allow us to yes, indicate just a limited number of companies obliged for this this obligation. What is new is that for companies that are in the limitation of preparing corporate country-by-country reporting, then this group of companies will be obliged to submit the master file to the local tax authorities, to the National Administration Office. Taking into account the general simplification propositions, I would like to highlight and get a view of a couple of them. The first one is, as I said, the changes into transfer pricing documentation, and the good proposition from the government is to insert into the corporate income tax the extension of the deadline for preparing the transfer pricing documentation. However, we need to be aware that Poland still keeps the deadline for tax return at the end of third month after finishing the fiscal year, which is which is normally when we have calendar year at the end of March. This means also with respect to the new regulations that taxpayers got obliged to set transfer prices on the daily basis with respect to their behavior as they would acted as independent companies. Yes, this provision could be seen as inserting the obligation for setting transfer prices on a daily basis. However, the obligation to prepare transfer pricing documentation is prolonged for local documentation. This is 9th month. For master file, we have time to prepare and be ready to reveal a master file within the after 12 months. The next interesting proposition, the adjustment, is with respect to the modification of transfer pricing adjustments. The proposition includes a couple of criteria which might create a bunch of criteria which might create the difficulties to be met with respect to all of them. For transfer pricing adjustment, the expectation is that the adjustment will be done in the course of for the particular tax year, and the adjustment should be revealed within the tax return that will be issued with respect to the particular tax year. As I said before, the new provisions also introduce the kind of totally new tool with respect to the transfer pricing provisions that we have before. This is a safe harbor provision that allows us to feel safe under conditions given in the provisions. These safe harbors are indicated for low value services as well as loan transactions. For low value services, we are safe. We are within the harbor when remuneration, when the markup is set at the level of 5%. While for the loans, provision sets that government, Minister of Finance will issue on the annual basis the decree that will indicate the proper basis for calculation the interests. What we also have with respect to the changes, I would say, as Marcin said, kind of a revolutionary approach with respect to the arm's length principle. This means that with respect to new provision, the adjusted arm's length approach permits the tax authorities, and this permutation is directly in local regulations, that tax authorities will be able to recharacterize or even disregard the transaction. I will develop a little bit on this later. But I'd like to also highlight the other new propositions with respect to arm's length principle that I find interesting. The new proposition also follows the OECD approach with respect to introduction of sixth method, which is the valuation techniques. Poland decided to introduce these valuation techniques as the sixth method outside of the fifth methods that were until now used. The sixth method, the recommendation for using this, the valuation techniques is with respect to the awareness of taxpayers, but also the tax authorities, in cases where those free methods that we already know are not, I would say, feasible enough to be used to deliver the proper valuation of transfer prices. As I said, we have changes with respect to the wording given for the arm's length principle. It is the wording for this standard is slightly diversified with respect to what we have right now. What should be highlighted with this new wording is the new approach of tax authorities to focus more on being aware of the substance of a transaction. So the new provisions give the recommendation for delineation of actual transaction, which means, in the words given in the proposition, that tax authorities will take into account actual realization of controlled transaction and behavior of the parties. With this respect, what is also I would say the challenging proposition from the government is that tax authorities are allowed to make upfront recharacterization and non-recognition of transaction only by one condition indicated in the provision. So the condition says that if tax authorities recognize that under comparable circumstances, independent companies directed by commercial rationality would not enter into controlled transaction or enter into different transaction, then tax authorities are allowed to enter into the are allowed to recharacterize controlled transaction or non-recognized or even non-recognized. We don't have any other provisions that give us the background of the manner in which tax authorities will approach, will use this right for the recharacterization and non-recognition. We still have, yes, the proposition for issuing decrees. We have draft for decrees that indicates a couple of important criteria for tax authorities for analyzing with respect to comparability issues, analyzing the transactions, but as it is written at this point of time, the proposition about the recharacterization is not entirely written in a way that would satisfy the best awareness of how this recharacterization and non-recognition should be treated by tax authorities. I highlighted this issue also with respect to, yes, proposition of shifting the burden of proof of setting the transfer pricing on the taxpayer's shoulder. With this respect, Ministry of Finance is very clear on their position that taxpayers should be aware and should be focused on setting the transfer pricing in accordance with the arm's length principle, so in accordance with the behavior of independent companies on a daily basis. So these are the main topics that, yes, we found interesting for you at this point of time. The proposition right now is still in the Parliament, and yes, we are still waiting for the final wording of this revolutionary changes. Thank you very much.
Okay, so thank you, Monica. Right now we will switch to the next point in our presentation, which refers to the IP box. Perhaps just one issue that should be also mentioned is that all of these changes that we are discussing, although they stem from several draft regulations proposed and drafted by different bodies or together with different bodies within the Polish administration, they are discussed mostly together by the lower chamber of the Polish Parliament. So they are at all of these changes that we are discussing are at the same stage, and all of them, with one exception, are going to be binding. At least that's the plan right now from the beginning of next year. Given the way that the proceedings are ongoing, we feel that it is realistic that all of these changes will be actually implemented as of the beginning of 2019. As you might recall from our previous meetings, previous webinars, most of the changes discussed so far were unfortunately of a little bit a negative nature for Polish taxpayers, meaning that what the new regulations were doing was limiting tax deductibility of certain items, certain positions. So that's why we decided to start this section of the webinar with a sort of a sweetener, with an idea of the Polish Ministry of Finance that stems from the need that has been perceived in Poland to escape the middle income trap. And to do that, there are a lot of regulations, not only supporting R&D in form of R&D relief, but also to increase the generation of R&D or intangible property in Poland. It has been decided to introduce a so-called IP box or innovation box. This is a group of regulations which are to stimulate generation of intellectual property in Poland via taxing the proceeds, the income from these activities with a preferential, much lower tax rate. The rate is to be set at 5%, so it looks enticing, and the idea is not only to promote internal Polish development of IP, but also to encourage foreign multinationals to locate R&D centers in Poland and to develop IP in Poland. The new regulation or the preference stemming from the new regulation will last for the whole period of IP protection. So, for instance, in the case of patents, it will last for 20 years, and it will refer to a selected group of rights, to a selected group of IP, meaning that the proceeds or the income from rights such as patents, computer software, medicinal products, rights to industrial designs, utility models, and integrated circuits will be taxed with this lower preferential tax rate. As the tax basis, the authorities decided as of now to list a group a specific group of types of income or types of revenue, meaning royalties, meaning proceeds from sale of these rights, but also what is key, valuable, but will be ultimately administratively difficult for taxpayers, is that also when IP constitutes a part of a product or a good sold, also income derived from this IP in a given proportion will be able to be subjected to the preferential tax rate, as well as let's call them proceeds, but the revenue or income stemming from indemnity or damages paid due to IP infringements. These are all the positions that that will be subject to this preferential corporate income tax 5% rate. In terms of IP constituting a part of products, what is I think key to know is of course to address or try to how to establish this this value as a part of the product. And here the Polish regulations make a reference to transfer pricing principles. So the market value of IP established potentially via benchmark or some other activity will need to be set in order to be able for a taxpayer to calculate the amount of income subject to the or income taxable with the 5% preferential rate. In terms of the mechanics of IP box, this is in principle based on OECD guidelines. So for people familiar with the OECD guidelines in this area, and for also for foreign taxpayers, this shouldn't be a great surprise as to how this particular regulation is constructed. So what is important to know, and what is also clearly addressed in the regulation, is that the IP should be developed in Poland, that R&D works should be conducted in Poland, and the calculation of income subject to the preferential tax rate includes provisions which are drafted in such a way as to assure these two conditions are met. And what we have here is an element of the calculation of income subject to the preferential corporate income tax rate, which is indeed introduced to assure that only legitimate and only such R&D works and such IP generation which is conducted in Poland, which is conducted by taxpayers themselves and not procured or purchased from other entities, whether Polish or foreign, is taxed with this preferential tax rate. So basically, any income that is derived from the sale of rights, from royalties, from sale of products, including IP, should be multiplied, or in order to establish the tax base for the 5% rate, this income from sale, royalties, etc., should be multiplied by this perhaps not excessively difficult, but still rather uncommon in the area of Polish CIT corporate income tax formula. This formula basically assures that all the R&D works or costs of R&D works performed by the Polish taxpayer himself, plus R&D works for the IP acquired from unrelated entities, determines the actual value or the actual amount of income subject to the preferential taxation, whereas costs of R&D works and costs of acquired IP which are acquired from related entities in terms of R&D and cost of IP directly required from outside, let's say, the taxpayer's business. So basically, acquired IP will diminish the impact, diminish the extent and the amount of income subject to the preferential tax rate. The questions that surround this regulation are, in our view, particularly around the area of properly calculating costs at the stage of establishing income subject to the preferential tax rate before multiplying this income via this formula or by this index. And also there is always the question of the approach to separating or documenting the actual costs and income recorded from IP, which could prove very difficult, very administratively complex, because we know from other areas the approach of the Polish authorities is to have these types of any types of preferential tax areas or tax treatment very strictly, very strictly documented in a very detailed fashion. So these are the two areas that we will particularly watch the development of during the parliamentary works, and if there are any significant changes, of course, we will also let you know. So in terms of IP and the Polish tax preferences, I think that that would be it for now, and I'll hand over to Michał to discuss the international tax aspects of the most recent planned changes into the Polish corporate income tax.
Thank you, Marcin. So from the international tax aspect, there are a couple of changes and propositions that are put in place and will be effective as of the 1st January 2019. And I will talk a little bit about three of them. One will be mandatory disclosure rules. Another will be exit taxation, and will also cover withholding tax obligations, which will also go through revolutionary changes, actually. So starting from mandatory disclosure rules. These regulations, as you probably know, results from BEPS works. One of the action plans that was introduced in BEPS is about mandatory disclosure. And Poland implements these regulations on the basis of a EU directive on mandatory disclosure of information and automatic exchange of information. This set of regulations actually aims to give the tax authorities in different member states a tool to gather information about the aggressive tax planning and tax schemes. So basically, it's a measure that should make taxpayers aware that implementation of aggressive tax schemes is not welcomed, and the tax authorities want to have this information upfront before actually the certain tax scheme will be implemented and used. And this set of regulation actually aims to give all the taxpayers a level playing field, so that it's not that the big taxpayers are able to afford for tax advisors and are able to afford the expensive tax schemes, and this could potentially put them in a better position comparing to the taxpayers who are not benefiting from this type of schemes. So going to the details, the Polish proposition will be effective as of the 1st January 2019, 2019, most probably, if the draft legislation is and it's voted in its current version. What is worth mentioning is that in Poland, not only cross-border schemes will be reported, but also domestic ones, which is something that differs it from the proposition mentioned in the directive. So what basically mandatory disclosure rules mean is that cross-border arrangements and domestic arrangements that fulfill certain criteria will need to be reported, will need to be notified to the tax authorities, and I will mention a little bit later how in practice is going to work. But these, not of course all tax schemes, not all tax structures will fall under this reporting obligation. For the cross-border arrangements, the most important main benefit test will need to be passed. So if the tax scheme is aimed mainly to obtain a tax advantage, and also certain features called hallmarks, specific hallmarks are also met. Just to mention some hallmarks, the general ones would be if there is a relation between the intermediary, intermediary can be a tax advisor, attorney, employee of a bank, people who are involved in designing, marketing, and implementing tax schemes. If the relation between the intermediary and the customer, taxpayers, is based on confidentiality, and there is a remuneration of a tax advisor set up based on the success fee basis. This will be the general hallmarks that would indicate that one of the features of the aggressive tax scheme is there. Specific hallmarks will be those that describe the tax arrangement as, for example, taking over a company with tax losses and using the tax losses of this company to set off tax liabilities, or creating cross-border deductions between related entities will be something also that would characterize an aggressive tax scheme. For domestic arrangements, we need to talk about something called qualified beneficiary. So basically, not all taxpayers will need to report arrangements that will have this main benefit test and will pass also the specific test, this hallmarks, but they also need to have revenues or costs exceeding a threshold of, in the presentation mentioned 30 million Polish zlotys, but it's going through changes while the legislative process goes. And the most recent version of changes to the tax code, there is 10 million euro mentioned for qualified beneficiaries. So definitely these numbers will change. And how the process will work, just from high-level perspective, because we don't have enough time to go into details. But what is important to remember is that the intermediary will be required to report tax arrangements, aggressive tax arrangements. As I said, intermediaries are defined as tax advisors, attorneys, legal counsels, but these are only the examples. Anybody who is involved in preparing, marketing, implementing potentially aggressive tax schemes will fall in this group. And if there is something that fulfills this criteria that I mentioned before, the intermediary will have 30 days to notify the National Tax Administration that such scheme has been presented to the customer, to the taxpayer. There are exemptions from this rule. So if in Poland there is an individual who is involved in designing and marketing the tax scheme, is actually obliged to follow the professional secrecy rules. So, for example, taxpayers have such attribute. Then, in most cases, this obligation will be passed. The reporting obligation will pass to the taxpayer, and the tax advisor needs to notify both the tax authority and the customer that she will not notify about the tax scheme, but this will be done by the taxpayer. And besides that, the intermediary will also need to prepare certain information that is required by the head of a national tax administration about the tax scheme, and will need to pass it to the taxpayer, who will actually share it with the tax administration. And this information that will be gathered by the Ministry of Finance, by the National Tax Administration, will be exchanged on a quarterly basis with tax administrations from other member states to fulfill this goal that was mentioned by me at the beginning. What is important from practical point of view about the mandatory disclosure rules is that also they say that if the intermediary, which revenues or costs exceed 8 million Polish zlotys, that's the threshold that is right now in the draft legislation, such entity will be obliged to prepare internal policy for its employees about the mandatory disclosure, basically describing how people should follow the rules so that aggressive tax schemes are properly reported. And it will be just very important to have this policy, as not having it, there will be fines and penalties imposed on such intermediaries that did not put in place such a policy. And they can range from 2 million Polish zlotys up to 10 million Polish zlotys. So it will be very important to make sure that such a policy is in place. Now a couple of words about the withholding tax, because within the withholding tax area, this is actually a revolution, just because as you know, in Poland, withholding tax works in a way that's method called relief at source. So if a tax remitter, so an entity or individual making certain payments to non-residents, right now, provided that tax remitter has a certificate of tax residence of a recipient of the payment, and other documents that are required for benefiting from the exemption, basically the reduced rate from the treaty, double tax treaty, or the exemption from the domestic regulations based on the interest royalty directive or parent subsidiary directive can be applied. And right now, the change is about going from this relief at source model to the tax refund model. This is a model that is also in other countries. So, for example, Germany operates such a withholding tax mechanism. The idea behind implementing such regulation is that the Polish tax authorities want to have a better control over the verification whether the taxpayer, usually non-resident taxpayer, is enabled to benefit from exemption on the reduced rates. And going to the details, we are talking here about the threshold of 2 million Polish zlotys. And if the tax remitter makes payments to a particular taxpayer within one tax year that is below 2 million Polish zlotys, the old rules will stay. So basically, then we can rely on the reduced rates or exemptions if we fulfill the criteria. However, if the payments exceed 2 million Polish zlotys to one taxpayer in one tax year, then what happens is the domestic withholding tax rates will apply. So for interest, royalties, certain intangible services payments, it's 20%. For dividends, it's 19%. And once the tax is paid by tax remitter, then there will be a chance to apply for a refund, which should be quicker and based on the assumptions. And I will go through different possible routes of for the taxpayer or tax remitter that can be taken. So to avoid payment of withholding tax by tax remitter, the tax remitter what can actually do is to issue a statement and submit a statement to the tax authorities saying that all the conditions and all the conditions mentioned in domestic regulations or double tax treaty are fulfilled. It's not just a simple statement that we know that there is a foreign taxpayer and we have a certificate of the tax residency, but on a tax remitter and actually on the head of the tax remitter, there is a responsibility to be due diligent and to make sure that all the conditions were checked for exemptions or reduced rates. So what will be the most important is to make sure that we are paying to the beneficial owner of making payment to the beneficial owner, and that there is actual economic activity of a non-resident in a particular country. So there will be a lot of checking and a lot of verification to be done. And we as PwC we have a lot of experience in checking, verifying the possibility to apply such exemptions based on experiences we gather from other countries. We are able to help you with making this verification. It's important because on the head of the tax remitter there is a penal liability to make sure that the statement is correct and is made in accordance with the factual state of affairs. Other option for certain directive-based exemptions will be application for a formal opinion to the tax authorities. So the tax authorities will also issue an opinion saying that there is a possibility for a taxpayer to apply exemption, and such opinion would be applicable for 3 years. And the last option, as I said, if there is no statement issued by tax remitter and there is no opinion, then and withholding tax is taken based on the domestic rates, the taxpayer or tax remitter, if it actually incurred economic cost of the withholding tax, will be able to apply for a refund, which should be made through electronic means of communication. And in theory, this refund should be quicker, made within 6 months, provided that the situation is clear and taxpayers should be able to get such a refund. And now we have a short question to you, dear participants. We just wanted to ask you if, in your practice, do you have payments of interest, royalties, or certain tangible services that to non-residents that can exceed this threshold of 2 million Polish zlotys, which is around 475,000 euro in a year? So we'd appreciate your responses within this short survey.
Had we've had.
Okay, so I'll end this poll right now to see the results. And it looks like 53% of participants said no and 47 said yes. And basically means that quite a lot of you or your companies actually make payments to residents that will fall under these new regulations. So all those new administrative burden will need to be somehow addressed. Because, as I said, either we'll need to go through the tax refund mechanism, or the statements or tax opinion could be a way to go, something that could be undertaken, so that this withholding tax is not frozen with the tax office. So definitely there will be a lot of work around withholding tax obligations as of the next year. Thank you for your responses. The last area I will go through briefly is the exit tax. So as you must have heard, Poland, as also other member states, will introduce exit taxation. It's also an obligation resulting from the anti-tax avoidance directive implemented on the EU level. And how it's going to look like in Poland. Basically, it will apply both to the corporates, but also to the individuals. So this is something new and not met in the directive. But without getting into details, any company that will move certain assets abroad or move its residency abroad, but still staying the owner of the asset, will need to pay tax on the unrealized gain that is associated with those assets. To give you an example, for example, if the shares of the company that appreciated, they're very appreciated over time, were moved, for example, from the Polish PE to the head office that is located, for example, in Germany, such appreciation of the value of the shares will actually be subject to 19% tax in Poland, because Poland will lose possibility of taxation of such asset. So as I said, for corporate taxpayers, the exit tax rate will be 19%. The tax base will be the difference between the market value of the asset that is moved and the net tax value of the asset. And this hypothetical gain will be subject to 19% exit taxation. In cases where there is a taxpayer actually that moves certain assets from abroad, from EU member state, and such assets were subject to exit tax in that country, then there is a sale in Poland, there will be a possibility to credit exit tax paid in the other country with the Polish tax, basically. And by the 7th day of the next month, when the exit tax was applicable, there will be a requirement to submit a declaration on that. So thank you very much. That's all from the international tax angle, and now the notional interest deduction. I'll pass to Marcin.
Thanks. Thank you, Michał. Since we are a little bit short on time right now, I will try to go through the next 2 or 3 points very, very briefly, of course, without omitting the key, the salient details. And the next 2 points are generally about the idea of ending tax preferences for particular types of operations, or for particular types of actions undertaken by taxpayer. Notional interest deduction, it's not a foreign concept to the tax law within the EU or around the world, and the idea is, of course, to offset or cancel the benefit of financing or providing financing to a given taxpayer via loans, which have on them, which are covered with interest, which is tax deductible, against paying contributions into the equity of a taxpayer, or financing the taxpayer with retained profits, which do not have any tax preference, because there is no interest on such payments. So the idea that is being introduced into the regulations, which is positive because it's an additional possibility to generate tax costs, is the notional interest deduction, which will be available for contributions paid into Polish entities or retained profits remaining in Polish corporate income taxpayers. The interest calculated will be based on the reference rate of the National Bank of Poland, which is currently at the level of 1.5%, increased by an additional 1%. So basically, the interest on contributions and on retained profits will be, as of now, 2.5%. And this is actually the only regulation which will become binding as of 2020. However, any contributions or retained profits contributed in 2019 will be included in the calculation for 2020. So basically, that's the idea. That's the principle. There are a couple of limiting conditions, of course. First one is that the actual amount of notional interest deduction cannot exceed 250,000 Polish zlotys, which with the current interest rates means that only contributions or retained profits up to the level of 10 million zloty will be subject to the deductible notional interest. Plus, the contribution and retained profit cannot be returned, refunded, withdrawn within 3 years. Within 3 years, in order to benefit from this deduction, or not to need, in order for there not to be a need to refund this deduction. So this is basically the idea behind notional interest deduction in Poland. And the second element, which is also about ending tax preference on certain areas or types of actions, is the introduction of deductibility limitations for car fleets. The explanation behind it is that especially in the case of leasing, the Polish taxpayers preferred to use leasing arrangements instead of purchasing vehicles for their economic activity, due to the fact that depreciation for vehicles was limited. The value, or the depreciable value of a vehicle was limited at 20,000 zlotys. 20,000 euro, whereas the cost of leasing are unlimited. So right now the idea is to introduce a limitation both for leasing, for cost of leasing, and costs of depreciation of purchased vehicles at the level of 150,000 zlotys, so around 35,000 euros. This is multiplied by 50% in the case of electronic vehicles, but generally the key change here is that leasing installments, leasing payments exceeding 150,000 zlotys for non-electric vehicles will be non-tax deductible. This is the principal change that is going to be implemented from 2019. But it will be binding only to leasing contracts which are signed, which are concluded after the introduction of this law into force. The second change regarding cars and the costs of their use, cost of using cars in business activity, is with respect to the fact that the Polish VAT law a couple of years ago introduced a limitation on deductibility, or a limitation of the possibility to include input VAT related to cars, to vehicles, at the level of 50% in the case of mixed-use vehicles. Meaning that if a car is used for business and for private purposes by an employee of the company, it's possible to treat only 50% on input VAT on leasing and on cost of use, such as fuel, etc. It's only possible to treat 50% of input VAT as or VAT on these costs as input VAT. And the idea right now is to introduce a similar regulation into the corporate income tax, where 75% of costs of use of a vehicle, so principally fuel, will be allowed as a corporate income tax deduction. 25% will be non-deductible in the case of mixed-use vehicles. And what is important to note is that this, contrary to the VAT regulation, this doesn't, in corporate income tax, apply to leasing costs. It only applies to costs of use, which should be defined as fuel and other expenses of that nature. What is also, I think, worth mentioning that in the case of VAT, there have been significant difficulties in practice in the area of proving that the vehicles are not mixed-use vehicles, and I think we can expect similar difficulties in the case of corporate income tax as well. But we will see how this particular change proceeds through Parliament. There have been significant changes to this provision so far, and this limitation has been decreased from 50% during the course of legislative works to 25%, so we will see the fate of this particular provision. Right now, what we would like to do is to perform some sort of summary, because we are basically out of time right now. Some sort of summary of the key issues, or the issues that we thought were the most crucial ones in the changes, and we will ask you to participate in this poll, which basically lists also the key topics that we have discussed. So what do you feel is most, which changes do you feel will most impact you, your business, your operations, whether it's transfer pricing compliance changes, which are, as Monica mentioned, of a very sweeping nature, whether it is IP box and you feel this particular regulation will be beneficial, or whether you feel withholding tax will have the biggest impact, which, at least in my view, could be most significant for taxpayers operating internationally. Or, however, also the car fleet costs, which are, I think, in popular press, the most hotly debated issue, because it affects basically every single business, and it will decrease allowable tax costs. This could be also significant. So we are having the poll right now, and I think it's pretty even in terms of transfer pricing compliance, withholding tax, and car costs. And IP box has not been mentioned by any of our participants willing to join the poll as an item that will be significant for them, which is maybe not entirely surprising, but a little bit, but not that promising to, I think, also to Poland in general as a country trying to develop more IP to increase its R&D competences in the coming years. So thank you for participating in this poll, and I think we can quickly just mention one maybe not mainstream change, but it could be also important for particular taxpayers, which is the regulation in corporate income tax and personal income tax as well of taxation of virtual currencies. Just very briefly, the key principles will be that virtual currency exchange only for conventional money, conventional currencies will trigger tax obligations. Any actions that will take place virtually, so exchanges of virtual currencies for other virtual currencies, will not trigger taxable events. So I think this could be regarded as a positive development in the context of past views expressed by the Polish Ministry of Finance. And any tax cost that will be allowed to be recognized will be cost directly related with proceeds, with revenue from virtual currencies. Again, only revenue considered, regarded as exchange of virtual currencies for conventional currencies or goods or services, etc., etc. These in corporate income tax will be allocated into the capital basket. What is also, I think, important is that, crucially, there will be no similar mechanism for recognizing tax loss as exists for all other types of business activity. It's rather that costs directly related with virtual currencies will be recognized in the year they were incurred. If these costs exceed revenue, they can be added to the costs of the following year. So no typical 50% tax loss deductibility over 5 years mechanism will be allowed in this case. So I think this is a very brief, very quick wrap up of all the corporate income tax changes that are being debated, that are being introduced and hotly contested in the parliament, as well as during our discussions with all of you and with our other clients. And I think we will be wrapping up our broadcast, our webinar here. So I think it's worthwhile definitely to thank all of you. I also understand we had some minor technical difficulties during the presentation. So in the comments section we have posted a link to the recording of the webinar. So please also use it as well. Thank you very much.
Thank you.